Thank you, everybody, and welcome for attending our 2021 Economic Outlook briefing. We are so thankful that you're able to join us this year, and apologize we cannot have this event in person like we normally do with breakfast, but hopefully you're enjoying breakfast on your own and you are ready to get started with what I think is going to be a great session. Real quick, I would just like to thank very much our sponsors this year. Once again, we have our main headlining sponsor is MBT Bank. And we also have sponsor Preferred Mutual as a supporting sponsor. Thank you to our sponsors who made this event possible. Not only are they still willing to support an event like this, which is so appropriate right now, but they made it possible so that all of our members could attend this event free of charge, which was just a wonderful member benefit to give to all of you, and we thank them so much for their support. Real quick, just to go over today's agenda. I will be providing opening remarks right now, as you can see. Coming up after me is John Watt, who's President and CEO of MBT Bank. Our main speaker today is Ken Entman, CFA, and then I will be coming back and giving you a few closing remarks and giving you some updates about the work of Commerce Chenango. Probably should tell all of you, in case you don't know, my name is Carrie Green. I'm President and CEO of Commerce Chenango. This is my second Economic Outlook event with you. I began with Commerce Chenango about 1.5 years ago, and it's wonderful to be here and to be able to present in this format to you. We can't thank everybody enough for taking time out of their morning to be with us today. It's a little strange for me. We were just talking about this in the office the other day. I really feel like this event was sort of a pinnacle moment for me and for our area. It was this time last year. We were talking about what was going on with COVID. We were starting to hear about it in the news, and Ken spent a lot of time talking with us last year about what that could mean for our economy, events like this that had happened in the past. And, little did we know that, just a couple weeks later, things would explode the way that they did. So I know I'm dying to hear what Ken has to say about what this post-COVID economy is going to look like down the road. So I will get to my updates so we can hear from who you're really here to see. Just want to give you a few updates from Commerce Chenango, what we've been working on. We've had a very busy year. 2020 was crazy for us, like it was for all of you, I'm sure. Despite going through what we went through as a community, and Commerce Chenango really taking a lead role with our businesses in terms of advocacy and education, support, financial assistance. All of our businesses hurt last year, and we were very happy to be such a strong partner with our business community, with our local Department of Health, with our county legislature, and our state partners. We're really happy that we were able to serve in that role for you and provide you the information that you needed. Despite all of that took up so much time, we really accomplished some amazing things in this past year, one of which was our brand new website and our rebrand. We have a brand new logo. We have a new tagline, Move Chenango Forward, that we've been using. We have a brand new CMS system, client management system, that we are using to make our website more navigatable for our members. And our website is pretty awesome. If you haven't checked it out yet, you definitely should. We are really putting a focus this year on that continued marketing. We were really pleased to have such a wonderful write-up in the Progress Chenango edition that just came out a couple of weeks ago. A wonderful story written by Melissa Stagnero, which was fabulous, that really highlighted all the work that we did this past year and what some of those goals are for the future. So if you read that article, some of this might be repeat for you. If you didn't, please grab a copy. We'll actually have some here at the office as well. We're going to continue this push in marketing and trying to focus and let the community know who we are and what we do. That was part of the rebrand. That was part of why we came up with our new logo. We felt like it was important to have our community and our partners really understand who we are and what we do. Commerce Chenango is a pretty big organization. We are the Chamber of Commerce, supporting businesses and advocating and working with them side by side. We're also the economic development arm of the county, which is a pretty big responsibility. We take that very seriously. I feel like everything that we do in this office really leads back to that economic development strategy that we have. And we also are the tourism agent for the county. All of the tourism is handled out of this office, and we work hand in hand with our tourism properties across Chenango County and with our partners in the region. We have a 501c3, which is our Chenango Foundation, which is very active. We have a very invigorated board. We actually just had a board meeting yesterday, went very well. They have a lot of great ideas. They have a lot of energy. I have a lot of energy and they are wearing me out. So I'm very excited to see what will be coming out of Chenango Foundation in the next few months. In addition to that, I did mention the economic development that is run through Development Chenango Corporation. And we also we have the Chenango County IDA is handled out of this office as well. So, we want the community to know that. We want them to understand all of the arms underneath our organization. We'd like to refer as Commerce Chenango as the umbrella, and we're really putting an increased focus on marketing this year to really make sure people understand that we are a resource to them. We're the little bit of everything in this office. So that's one of our priorities. Continue to focus on membership, and with that, we have some wonderful new tools and resources for our members. We just, hot off the press, we just got a brand new book. It's a membership book that we put together that highlights all the things that we have here at Commerce Chenango, all of the things that make membership worth it, make your investment worth it. If you ever wondered about the investment that you make to Commerce Chenango and what you sort of get for that, I like to refer people to last year. That's what we do. We do a little bit of everything. We change what we do based on the business and their needs. And we're really trying to put a renewed focus on membership. Our Director of Membership and Programming has been here for just about a year now, Mary Miner. She's done a fabulous job. She has completely changed our whole membership approach from the ground up, and I'm very excited to see what she's going to be doing for our members this year. We are working on programs for this year. I'll talk about that a little bit later after the presentation about what we have planned this year, but again, trying to make sure that we are creating a program that is relevant to you in your business and your business's needs. Advocacy, again, is always something that I'm on the forefront. Actually, when we get off of this today, I have a call with NFIB. We're working on Small Business Advocacy Day. I was there last year in person. That was kind of the week that the bottom fell out, but we are still doing this virtually, and that's something that we do, working with our legislators about advocacy related issues, legislation, things that are affecting small business, large business, ag, manufacturing, wherever you are, that's what we do. And grants and loans is something that we've started gearing up again as well. Joanna Cacciola joined our crew back in August, and she has grant writing experience, and she has hit the ground running. We are really working hard to support those businesses to get them what they need. So very excited about what we have going on here under Commerce Chenango. In terms of economic development, I think it's always important to tell you what we're working on. We try to talk about this, we share it out, but here just highlighting some of the priorities that we have this year. Broadband, we've been talking about that for a long time now. I'm a part of the 7 Tier 8 Broadband Coalition, which is working on accessing broadband to the whole 7th tier. If you attended our legislative breakfast in last October, you know that I'm also working on this on the Chenango County level. We're working very hard to try to get the funding that we need to get broadband access to everybody. I feel like broadband is a basic utility that everybody should have, just like electricity. I don't think it's fair that not everybody does. Areas that are very rural like ours, it ends up not being a good investment for companies to do what they need to, which I don't think is right. Just because we're rural doesn't mean we shouldn't have electric, right? So we should have broadband, and I really feel strongly about that. So we are working hard. If we have to go town by town throughout the entire county, we will make sure that everybody is going to have access to quality broadband connection, and that's something that I'm working on very hard with our partners with the county. Childcare is a new initiative. Not a new problem, but I was very pleased to see that childcare and access to childcare was one of the priorities set forth by the state. We are a childcare desert here in Chenango County. I hear it from our employers. They have a hard time attracting and keeping some of their younger professionals because there just isn't enough childcare. I've heard story after story about this, and we need to find a way to solve that problem. So I don't know what the answer is yet, but we are working on it. We hopefully will have some news soon about some possible hotel and lodging here in Chenango County. Earlier in the fall, I actually was put on a brand new work group that Empire State Development has come up with called Tourism and Business Development. And that's really related to the tourism industry. How do we have businesses that support the tourism industry? It's a wonderful group of people. I'm hoping to have some great ideas come out of that later this year. We're always working on business development. Joanna has been so busy. Every time somebody calls, we have so many calls from people who are looking to start a business. They want to expand a business. We have developers that are looking to come here. If there's one thing that you take away from this, I want you to know that things are going well in Chenango in terms of new business ideas and development. They want to come here. They're attracted to the area. They want to be here. And they're contacting our office, and we're trying to do what we can to find them space, to find them, help them build their business plan, help them find financing. So we have been very, very active, very busy with that. John has been spending hours reviewing, business plans, and we are that connection for people as they're looking to look and expand and start businesses, and we're hoping to continue to do that and have some great developments here for Chenango County. And workforce development, there's a lot of groups and places that work on this. What we're really talking about when we talk about workforce development is that talent pipeline. How do we attract people to our area? And I really feel like all of these things I've mentioned on this slide go directly to attracting that workforce that we need. We want people to, move here. We want them to have their families here. We want them to make a life here. We need to have a way to attract some of those professionals to this area. We have a lot to offer. So we're working very hard on that. And later on, I'll talk about one of the events that we have coming up in just a few months that will focus on that. So I want to get right to the heart of the program, so I know that we have a lot of great information to share. I would like to introduce John Watt. He is the president and CEO of NBT Bank. He is going to be introducing our main speaker, Ken Entman. I just would like to thank John. NBT Bank is such a strong partner with Commerce Chenango. People that work there, they serve on our boards, they're volunteers. They're always there, willing to help, willing to, coming to me and saying, what can we do for the community? What do our businesses need? And really being a partner to Commerce Chenango. I can't thank them enough for doing that. We so appreciate the effort that they make to be a part of the community, to want to make a change. And they're one of the reasons why we feel like we can really move Chenango forward. So I'd like to introduce John Watt and take it away, John.
Good morning, and thank you, Carrie, and greetings to everyone from NBT Bank. On behalf of the management team and our locally based employees, I want to say how pleased we are to support Commerce Chenango in continuing to present this annual Economic Outlook event. Last year, we gathered at the Country Club on February 27th, and soon after, we were all plunged into a world dominated by COVID-19. The challenges that we faced this past year have been significant and unprecedented. At NBT, our investments in technology and comprehensive pandemic response helped us to meet all of these challenges and keep the safety of our employees, our customers, and our communities as our top priority. As we moved through the pandemic and addressed its impacts, we also made progress on strategic digital initiatives. In the middle of the storm, we rolled out our new mobile and online banking platform and introduced a new home lending platform, completely digitized. And we did many, many other things to make access to our products and services easier for our customers and prospects. So NBT entered this year with momentum on many fronts. Our diversified balance sheet, our strong capital base, and the resilient performance of our credit portfolios in 2020 provides us with lots of optionality in 2021 to grow. And as we did when we exited the financial crisis 10 years ago, we will grow. Our commercial and consumer lending pipelines are active. Our wealth and retirement services platforms exited the year strongly and are well positioned for 2021 with assets under management and under administration at record highs. Last year, we had the opportunity to deliver over $540 million in relief to 3,000 businesses and organizations through the SBA's Paycheck Protection Program. This year, we are once again helping Main Street businesses through our participation in the latest round of funding under this program. So far, we have processed more than 2,000 applications from new and existing NBT customers for over $200 million in loans that will support tens of thousands of jobs. What is impactful as the numbers is the messages we receive from our customers, particularly our PPP customers. They are thankful that we are positioned to help them gain access to these funds quickly, and they describe how uplifting it is to receive PPP loans that will keep their businesses viable and protect their employees and their families. And we are honored to provide that critical support. So as I close my remarks, I want to thank Carrie and her team for never missing a beat in serving Chenango County business. Their dedication and creativity are a tremendous local resource that I know we all value. I also want to thank all of our customers for their flexibility during this past year. Internally at NBT, the phrase "stronger together" is our touchstone, and it applies so well to our relationships with our customers and communities. We are proud to work with you and for you and look forward to better days ahead. So now I am pleased to introduce NBT's very own Ken Entman. Ken is our Chief Investment Officer. And Kenny, you need no further introduction, so I'm going to turn it over to you. Thank you, everyone.
Well, good morning, everyone. Thank you, John. Hopefully you can hear me well. And what a difference a year makes. Like John and Kerry said, last year we were right on the forefront of COVID, and what a dramatic impact it's had on our world and continues to have on our world. And so I look at where we are today, and the title of my presentation is Anticipating a Return to Normal. I don't know what normal is anymore, but we're looking from an economic perspective to get back to some sense of normal. It's never going to be the same as what it was, whether we work remotely, people don't come back to the office. All those questions remain to be seen. But on a macroeconomic standpoint, I think things are clearly anticipating a return to normal. The stock market is trading at basically record high levels. Interest rates are rising in anticipation of an economic recovery. And thankfully, hold on, I'm having a little trouble here with my screen. Okay, thank you. Thankfully, the COVID numbers are improving rather dramatically, and that to me is the biggest reason why things are so optimistic. These charts that we give you are from the COVID tracking report. I caution you, they're from February 21st. As I think most of us know, the United States just broached the 500,000 death number, which is tragic. But I think the point of this chart is to look at the rollover in the number of new cases, the rollover in the number of new hospitalizations, and obviously that will result eventually in the rollover of deaths. Let's hope. Driving this is a ramp up in vaccinations. Clearly, the rollout of that has been challenging, more so in rural communities like Chenango County than in bigger cities. So that remains a challenge, but I think we're getting the hang of that. And I think more importantly, as it relates to vaccinations, is that I think we're right on the cusp of moving from being supply constrained in terms of vaccinations to being oversupplied. Just the last couple of days, Johnson & Johnson presented to the FDA, and it's anticipated that either Friday or Saturday their new vaccine will get emergency approval, and they are ready to roll out. They have 20 million doses stockpiled that can be rolled out by the end of March. And I think you're going to see over the course of the next month or so, and Pfizer and Moderna are also ramping up their production. So I think we're right on the verge of going from being rationing vaccines to being oversupplied, and that means it will open it up. I think the other important thing about Johnson & Johnson's vaccine, it's a one-shot dose, so you don't need to have to go back for a second dose. And it doesn't require the deep freezes that kind of force the current vaccination program to be very limited in terms of where the vaccine can be distributed. With Johnson & Johnson, it looks just like kind of a normal flu or measles vaccine, which suggests that we'll be able to go to our local pharmacy, our local grocery store, our local general practitioner and get the shot instead of having to go to a sports stadium or a convention center or something like that. So all of this is highly encouraging. I do think the biggest risk that we face as an economy and as a society are the new variants, and whether these vaccines work or not. The UK variant is, from what I can see, is the most concerning in terms of it's highly transmissible. The Johnson & Johnson vaccine seems to be while it's not as efficacious as the other vaccines, one of the things that it does appear to do is prevent transmission, which would be very substantial. But clearly the biggest risk to the economy is a resurgence in the COVID virus. And I think that would likely be driven by the new variant. So that is the wild card and a major risk. But for the time being, it looks like the virus is beginning to become under control, so that there's light at the end of the tunnel, and the markets seem to be reacting to those statistics. Let's take a second to go back. So last year we were talking about fourth quarter of 2019, and we were talking about the economy perhaps accelerating, which it was looking really good. Last year when I spoke at this event, we talked about how strong January and February was. And then COVID really struck with vengeance. And you can see the 5% decline in the first quarter of 2020, followed by a second quarter decline of minus 31.4. That is by far and away the biggest economic contraction, kind of self-imposed. We went into quarantine and lockdown, and then we started to roll out. The mantra then was flatten the curve. Didn't quite work. We've had basically two other episodes of spikes in cases and hospitalizations and death rates. But when we got through to the summer, the economy, you can see that 33.1% recovery. That's also of historic proportion. Just now at 8:30 this morning, the fourth quarter GDP for 2020 was revised to 4.1%. I think importantly, as we look out into the future, now this was the beginning of the year. The forecast was for the first quarter to grow at 2.3%, the second quarter 4%, 4.7% for the third, and 3.8% for the fourth. What's really interesting is we did have a significant rollover and softening of the economy in the fourth quarter following into January. I would suggest that was due to the runoff in some of the fiscal and monetary support systems, namely, John mentioned the PPP loans and enhanced unemployment benefits. Both of those programs ran out, beginning in the fall and September timeframe, and the economy kind of rolled over a little bit and softened. It still grew; it's positive 4%. But the anticipation was for growth is 7 to 10%. So that 4.1% that we experienced is disappointing, and it started to impact the first quarter numbers. What we're seeing is the economic numbers are coming in far better than expected. Indeed, you look at this first quarter estimate of 2.3%. Just this week, a major Wall Street firm revised their forecast from 3% to 6% for the first quarter. And for the second quarter, the consensus estimate, which you see here at 4%, is starting to ratchet up to 7-8%. And there's even one forecast that's in double digits. And that's being sparked by basically stronger economic numbers, which I'll try to highlight as we go through. So historic contraction of the economy that we all experience, creating all kinds of challenges. But the numbers appear to be moving in the right direction, and it's room for optimism that, in fact, we are starting to broach normalcy. Again, to put this in perspective, last year we were talking about unemployment below 4% nationwide. The unemployment rate in December of last year for Chenango County was 5%. You can see the black line here. We all know that with the economic lockdown, unemployment shot up to 14.8% nationwide. It has currently dropped down in January to 3.6%. So that's kind of a V-shaped recovery. If you think about unemployment, if you invert that, you get a kind of a V-shaped recovery. To put this in perspective for Chenango County, the low unemployment rate for Chenango County was 4.6%. It was 5% in December of last year. It was 11.8% in April of last year. And the last reading we have for unemployment in Chenango County is 5.6. So the unemployment picture in Chenango County looks pretty much like the national image. So this is great news, right, that things have improved. But it doesn't mean we're out of the woods yet. To date, there are still 10 million Americans unemployed, and so there's a lot of work to do. This morning, initial claims, so this is the weekly number that comes out that basically tracks the people who are filing for initial claims. If you look at the bar, the line on the bottom, I think this puts how traumatic the COVID impact was back in the spring of last year. You look at that March 27 spike to 6.8 million people filed for uninsurance on March 27th of last year. The reason why I go back in time with this chart so far is the worst number in the history of this economic statistic was 695,000 in October of 1982. And 665,000 was the second worst number in March of 2009 in the heart of the financial crisis. So we had a magnitude of 10 higher response in terms of initial claims. Quite remarkable. Literally about 15 minutes ago, this number came out, and the number for the last week was 730,000. So I talked about the rollover and the softening in the fourth quarter. You can kind of see it on this chart, and you'll see it on others. You can see how we were coming down, and then we kind of traded sideways. That, I think, is the failure of Washington to re-up PPP and enhanced unemployment, and it just created uncertainty. They did pass something in December, which I think has given us some light. A pretty good number, 730,000 this morning. I think it is somewhat weather related, so we got to take that number with a grain of salt because we know there's been a deep freeze, so whether people could even get to the unemployment office to file their initial claim. So there may be some noise, but I think more importantly is the trend is getting better, and I would expect that to continue as the economy improves. So the last few charts give you a sense of how historic and how deep the economic recession was back in the spring. But we also had a massive response to it. So let's first talk about the monetary policy. So this is the Federal Reserve. I won't spend a lot of time on this because I think we're aware of this, but the Fed cut interest rates to zero. They pumped $1.5 trillion of liquidity into the financial markets. To this day, they continue what is referred to as quantitative easing, where the Fed goes out into the marketplace and buys fixed income securities. So what they wind up doing is buying the securities, so they take the securities out and they pump money back into the economy. They continue to buy $120 billion worth of securities every month with the hope that it's going to suppress long-term interest rates, which will provide a stimulus. That continues to this day. Many of the market support programs, I give the Fed an A+. Back in March and April, there was significant stress in the credit markets, in commercial paper and mortgage back in the mortgage area, and high yield bonds and investment grade bonds, really across the board, muni bonds. And the Fed came in and created a bunch of programs that were allowed to lapse at the end of the year. Some people had some misgivings about that. But I will show you in a little bit that the credit markets are really well behaved, and I think the Fed did a tremendous job in kind of supporting the markets and de-stressing them. And right now the markets are there's very little stress apparent in the market. The Fed balance sheet is approaching 10 trillion. To put this in perspective, at the end of the financial crisis in 2008, 2009, it was about 4 trillion. And prior to the financial crisis, it was about 1.5 trillion. So a massive increase in the Fed balance sheet, which does lead to the question, how do you kind of reduce that over time? You can see the commentary from the Fed. What I will say is this, and Chairman Powell testified to Congress on Tuesday and Wednesday. The Fed is not changing interest rates anytime soon. Some of the comments from Fed Powell's testimony, they are not going to raise rates until there's substantial further progress in unemployment and inflation, and it's, quote, likely to take some time. So I'm going to take Chairman Powell at his word, and the last bullet point on this slide really tells the story. Interest rates, particularly in the short end of the yield curve, are going to remain very low for a long period of time, and that's basically what the Fed has said. And the Fed can justify that because when you look at inflation, it has been kind of flatlining for an extended period of time. This chart gives you the light blue line is headline CPI. The dark line is core, so it backs out energy and food prices, which tend to be more volatile. But you can see that inflation is running in that 1.5% range, and the Fed's target is 2%. So this kind of gives the green light for the Fed to be very aggressive with easy monetary policy. And if there's a risk that concerns me, and we'll talk about this throughout the rest of the presentation, is that the overwhelming consensus on Wall Street is that inflation is very benign and will be sustained at a very low level for an extended period of time. The bond market is starting to show some caution about the potential for inflation. Milton Friedman, the famous economist, will say there's too much money chasing too few goods. That's how you get inflation. And we have trillions of dollars sloshing around our financial system right now. But what that means is that if you look at these two charts, I think it's pretty telling. The chart on the left gives you the current yield curve. That's the dark line on the bottom. This is as of January 29th. But you can see where the yield curve was. So this is just taking treasury bills in the front of the left side of the curve and going out to the 30-year bond. You can see where we were in 2018. The top line, the lighter colored line, the lime green line in the middle is 2009. So what does that mean? Interest rates have dropped since 2018. And we are trading at extremely low levels. But I would caution you, just in the last couple of days, when you look at that 10-year note, you can see it hovering right around the 1% mark. In December, at the end of the year, the 10-year Treasury yielded 0.93%. At the end of January, it was 1.2%, where you see it on this chart. This morning, just overnight, based on strong economic numbers, the 10-year Treasury jumped from 366, where it traded last night, and is currently trading, based on a slew of economic numbers this morning, at 147. So you had a fairly decent steepening. You can see how the long end of the curve is steeper than the flat end. But the market does agree with Chairman Powell. When you go to the right side, the dark line is where we are today. The purplish line is where we go to the market. So this is not Ken Entenmann's forecast. It's not MBT's forecast. This is simply going to the Chicago futures market and saying, tell me where the market thinks rates are going to be in the future. And the purplish line is 1 year. That's what the market anticipates. And the 5-year line is where the market would expect the Treasury yield curve to trade 5 years from now. And yes, you see rates going up, but you're still talking about a relatively flat yield curve and, on a historic basis, extremely low interest rates. So I think the good news, and one of the things that's fueling economic growth and certainly fueling the markets, is that interest rates are low, and the consensus is overwhelmingly in favor of interest rates to remain low for an extended period of time. On the fiscal policy side, so this is coming out of Congress and the White House, we also had an equal and opposite gigantic response. So when you look at the Fed, it's estimated they pumped about $4 trillion into the economy. When you look on the fiscal policy side, it's estimated that it's 3+, probably closer to $4 trillion. For those of you who are involved with the PPP, and certainly John and our commercial team was deeply involved, the rollout of this was massive, but it was messy, but it was highly effective. The PPP loans, I can remember in the beginning, we had clients saying, when are we going to get the money? And the Treasury Department hadn't even provided NBT Bank with a loan document. So it's kind of, how do you give people money if you don't have a loan document? So very messy, very bumpy, but highly effective once it rolled out. As I mentioned earlier, the political failure to extend these programs in the fall led to a bit of a slowdown in sideways trading. But after the election in December, Congress and the White House passed a $900 billion, call it supplement. It was referred to as a skinny package. I don't know when $900 billion became skinny, but that passed in December. But as John said, we're right in the middle of the second round of PPP. So that money is just starting to enter into the economy. And I think it's starting to have some numbers. We are anticipating a vote in the House of Representatives tomorrow on the $1.9 trillion stimulus, quote unquote stimulus. I list here what some of those proposals are. If I had to bet this morning, it's going to be passed through reconciliation, meaning it won't be a bipartisan bill. I think the Republicans had counted this 1.9 with 600 billion. The Democrats have stayed with 1.9. As of this morning, based on what I'm reading, it's likely to go through reconciliation, which means it will not be a bipartisan vote. And there are some controversial things in terms of what the right level of payments, the first check mark should be. Should it be $1,400? Should it be $2,000? Should it be less? Support for state and local governments. I think everybody agrees we should support state and local governments for spending related to COVID. But if you were in bad shape before COVID, should we bail you out? The right amount of enhanced unemployment, that 400, is somewhat debatable, or is part of the debate. Schools and college, lots of money have been issued to schools and college. I read this morning that of the $4 trillion that has already been passed by Congress, still $1 trillion of it hasn't been spent yet. So you go down the list, and I think the most controversial of all this is the $15 minimum wage. I do think that has an impact, particularly in rural communities. There's a big difference between Manhattan and Chenango County in terms of minimum wage. There's lots of political debate on that, and that is a big part of it. Regardless of the politics, what this means is we will be getting additional massive stimulus coming into the marketplace, whether it's 1.9 trillion or we have some kind of negotiation that brings that down. It's still going to be massive. And it's anticipated that President Biden, and just about everybody would agree, when you listen to Kerry's discussion earlier about bringing broadband to the southern tier, that's part of that infrastructure bill, and that could be an additional $1 or $2 trillion. So when you look at the, yes, historic contraction of the economy, you counterbalance that with a historic government response, and that has gotten us to a point where now we're anticipating a pretty strong, we've already had a strong recovery, and now the question is going forward, can we maintain that, sustain that going forward? And we'll have plenty of money sloshing around the economy to help do that. It does beg the question, and it's something I've always talked about in this presentation over the years. It begs the question, how do we pay for this? Our debt has exploded. You can just see in the last 2 years, total outstanding federal debt has gone from 23 trillion to 27 trillion. The blue bar, that 21.9 in 2021, shows that our debt is now larger than our overall economy. Our GDP of the U.S. economy is roughly around $20 trillion, give or take. So our debt is now over 100% of GDP, which is typically right on the caution zone. When you start to go over 100%, you really start asking questions historically. So, we have an issue here. Our deficit was $2.3 trillion in 2020. Not surprising given all the COVID spending. And the Congressional Budget Office anticipates that the deficit will be $1.2 trillion every year for the next 10 years. So the debt issue is something that's starting to come into play. And how do you fix it? You either cut spending or you raise taxes. And I think right now where the markets are very jubilant is because you have all this money hitting the markets, and much of it is finding its way into the financial markets. But I think in the second half of the year, when we get through this 1.9 trillion, we talk about infrastructure, the discussion is going to turn to how do we manage the debt? How do we start to shrink the Fed's balance sheet? How do we pay for this? And that's really two ways you do it. You either cut spending or you raise taxes. And so I think the discussion is going to become a little bit more challenging as we go forward. From cut spending, I've shared this chart with you before. Nobody's done it, and there's this debate in the world of whether Republicans are more fiscally responsible or Democrats. I code this by the traditional red and blue. I don't think anybody can claim the mantle of fiscal responsibility. Spending seems to be on autopilot, and if you take the Office of Management and Budget, the estimate for spending is to continue to rise. We've talked about this in years past. The thing that really drives this is entitlements, namely Social Security, Medicare, and Medicaid, and nobody wants to touch that. It's the proverbial political third rail, but it's 70% of our budget, and if you don't really focus on this, it's very difficult to control spending, which leads you to higher taxes. This gives you a list of some of the proposals out there. Some of them are more controversial than others. I doubt you will get all of them given how balanced both the House and the Senate are. So I don't think you'll get a clean sweep here. From my perspective as a chief investment officer, I would highlight two. One is the increase in the top left, the increase in corporate tax rates from 21 to 28%. Whether you agree that this is necessary or not, it has a straight drop to the bottom line earnings impact on corporate earnings, and earnings are what drives the stock market. So I think that is a potential negative. And then on the bottom left, an increase in capital gains from 20% where it is today, and there's a 3.8% Obamacare, so it's really 23.8. But you would talk about capital gains and dividends going to ordinary income rates for higher earners, and that would be effectively a doubling in capital gains rates. And generally speaking, the market doesn't react historically well when those rates go up. So you have the potential for some negative corporate rates, but you got to pay for it some way. And so right now, I think the government continues to add fuel to the punch bowl, and we're having a party right now as we're coming out of COVID. The numbers are improving, the vaccinations are coming, we're flush with money and support programs. Why wouldn't the markets be reacting well? But I think as we get to the second half of the year, you're going to hear more discussion about the debt levels, more discussion about increased taxation, and potentially more inflation. And on that inflation front, you can see the pockets. Lumber prices are up over 100% in the last year. There are shortages of containers for container ships. There are shortages of semiconductors that have the potential impact of significantly raising auto prices, copper prices. Most industrial commodities are rising. And then there's an argument that the Federal Reserve has spent, and there's so much money that it's finding its way into excess speculation in the market, whether we're talking about GameStop, whether we're talking about historic low credit spreads, whether we're talking about huge activity in the IPO market, or what's now SPAC, special purpose acquisition companies coming public, all signs of potential excess. Chobani in Chenango County is planning an IPO this year. I think that's a good IPO, a real company with real products, with a long-term track record. So there's a question about all this money, and if you start to say, let's pull it out of the marketplace, that may have an impact on the financial markets. And certainly the bond market is showing signs of concern with that 10-year rate jumping up to near 1.5%. So we look at the economy, I think we have experienced a V-shaped recovery with a little bit of softening. I think these charts demonstrate that. And I think it shows that it's a V-shaped recovery. When you look at the manufacturing index on the top left, when you look at the non-manufacturing or the service index on the top right, you can see on some of these charts that there was either a rollover or a softening in the numbers. That again, I think is, you can kind of pin that on the failure to extend some of the support systems in the fall, but that's behind us. So I think you're going to continue to see this, these numbers do well. Recent numbers in the last week or so, retail sales are significantly better. Hiring has started to improve. Consumer confidence is up. This morning, durable goods came out. It was increased 3.4% versus an estimate of 1%. Industrial production on the bottom left, you can see how that has picked up. And small business confidence increasing again. You can see the rollover of the PPP program. That is prior to the reignition of the new program. So you can kind of see that V-shaped recovery in the economy. You can see it in the housing market in particular, which is on fire. You can see prices in the top left of the existing homes in most of the major metro areas. And again, whether we return to normal, lots of people migrating out of cities into suburbia. There's a shortage of homes, and you can see it across the board here. No matter how I look at housing, it is really on fire. However, what I will say is, on a macro basis, there is a V-shaped recovery, but you may have heard the term of a K-shaped recovery, and I do think that persists because, you know, if you're in the leisure and hospitality business, if you're in certain segments, you're still hurting. And I think a great way to show that is with this chart, and this chart gives you the investment returns. Now, granted, this is the S&P 500 by major economic sectors and industries, but it really gives you a sense of the winners and losers. On the left side, not surprisingly, the biggest winners: online retail, information technology, home improvement. Lowe's had fabulous earnings yesterday. Consumer services, capital markets, and materials as people, you know, put decks on their house and redo the kitchen, etc. And you can see the S&P 500 in the middle, up 23% over the course since this is as of February 19th, going back to December of basically 2020 plus this year. But on the right side of the curve, you can see the losers. You know, airlines, hotels, office buildings, the energy sector, retail. Now, what I will say is, since the beginning, really since September, these numbers have started to reverse. That right-hand side is starting to perform much better. Once again, the market anticipating great liquidity and funding from coming out of the government, as well as anticipating a rather robust economy. So what that's resulted in is all this liquidity is finding its way into the markets. No matter how I look at 2020, whether I'm looking at the investment equity markets in the blue, the S&P 500 up 18.4% on a total return basis. You can see even the Russell 2000 up 19%. Again, looking at, if you anticipate strong economic activity, small caps tend to outperform, and that has been happening, and it's continuing to happen this year. The S&P is up about 5%, and the Russell 2000 year to date is up nearly 15%. So the market is trading like you're having an economic recovery. Let's hope they're right. On the right side of this chart, bond prices, because interest rates have come down, they performed really well. So the market is doing well because of all the liquidity. What that has done, if we look at the valuation, so a concern I would have, so we've highlighted a couple of concerns: resurgence of the virus, how do we pay for this, and increasing interest rates. That really plays into this. This is the PE ratio of the S&P 500. You can see in the middle of the chart, The 25-year average at 16.6. And you can see where we are as of February, trading around 22 times earnings. There is no question that is historically high. You'd have to go back to the dot-com bubble to get anywhere close, and we're pretty close to that. Now, I think we can justify that because over the history of this chart, going back to 1996, interest rates as measured by the 10-year Treasury averaged 3.1%. And as you've heard me worry this morning, we've seen a spike in it, the 10-year rate from 1% to nearly 1.5%, but 1.5% is still half of what the historic average is. So that does justify a higher PE, but I do think there are pockets of speculation in the marketplace that's concerning. And if in fact long-term rates start to rise as the bond market perhaps protests some of this excessive spending coming out of Washington, this may be troublesome for the market in the second half of the year. Counterbalancing that is corporate earnings have been phenomenal. The fourth quarter earnings season is still underway, but just from what we were anticipating fourth quarter earnings were going to be on January 1st, earnings are 20% higher than we anticipated just a month and a half ago. And the forecast, given the GDP forecast I talked about in the beginning, are starting to go up, and you can see the estimates going up. So what I think this means is corporate America, we have all, whether we're in our personal lives, whether in our small businesses or we're in gigantic businesses, we've all learned to adapt. We've managed our expenses. We've added technology. We've done that. And I would argue that the business community has become lean and mean by necessity to adapt to COVID. But if we do get a return to normal, I would expect that the earnings leverage to be phenomenal. And I think that is room for optimism. So I think you're going to have this tug of war throughout the rest of the year in the financial markets, with high PE valuations being justified by low interest rates and being justified by growing earnings. But if rates start to rise, it's going to be that tug of war, and that's something that we would be concerned about. Lastly, in terms of the financial markets, I mentioned earlier, let's see, I don't know why this isn't sliding here. Hold on a second. Let me see if I can get this to work. There we go. There we go. Sorry about that. Lastly, we talk about credit spread. So earlier we talked about the Fed doing a fantastic job of easing the stress in the marketplace. So this chart is pretty interesting to me. This measures the spread, the incremental yield that investment grade bonds is measured by the bluish line on the bottom, and the maroon line, which is high yield bonds. And it measures the incremental yield above treasuries that corporations have to borrow at. And when times are trouble, that spread widens. And when things are good, that spread tightens. So you can see where we are today. Those spreads have come back, but you can see that big spike back in March and April. And that's where the Fed policy came in, that quantitative easing, where the Fed came in and started buying bonds across the curve. And this time was different than previous times, because in previous times, the Fed would only buy treasuries and agencies and government-backed securities, including mortgages. This time, they bought high-yield bonds and continued to buy high-yield bonds, buy investment-grade corporates, buy commercial paper. And the result is that they have forced credit spreads to come down. You can see the stress in the marketplace, and you can see the previous stress levels where we were on our way to the reaching spread levels that we achieved back in the dot-com bubble and the historic spread levels we achieved in the financial crisis. You can see where we are today. Markets are pretty well behaved, and I tip my hat to the Fed there. So I think the financial markets are in a sweet spot right now, but I think the second half may be a little bit more challenging. I'm just about up to time, but I'm going to just quickly mention GameStop. It's back in the news today. It's up over 150% in the last couple of hours, I guess you could say. You know, I think the democratization of the market, where people can trade on their cell phones and get involved in the markets, I think the sooner we can get younger people into the market, the better long-term investing can be. But I think the gamification, the fact that when you put a trade in, you get balloons and confetti on your phone, I'm not so sure that's a good thing. You talk about, it really does feel like when you win on a slot machine and the bells and the sirens go off, that's pretty difficult. Sticking it to the man, trying to, stick it to the hedge funds who make a lot of money. I don't think that's a long-term investment strategy. Trying to ban short-term selling, I think, is a horrible idea. It really does keep the markets honest. I shed no tears for hedge funds that lost money in this market, because leverage is a double-edged sword. And if you excessively leverage, it can be potentially catastrophic, as the GameStop trade was for Melvin Capital. But I also don't buy into this, the markets, the Wall Street conspired against the little guys. Margin calls, capital requirements, capital gains taxes are all a fact of life. There is no, so when they halted trading, I find it astonishing. And for people who work in banking, John mentioned our strong balance sheet at MBT and how much capital we have. In the heart of the GameStop crisis, Robinhood was $3 billion undercapitalized. $3 billion with a B. That's remarkable. How any financial company could be $3 billion undercapitalized, and that really raises some questions. I also think the idea that we are talking about a free lunch where everything's commission free. There is no free lunch. You're either paying with order flow, where Robinhood will sell, or Robinhood or any of the other fintech companies will sell their order to large organizations. Well, you're telling somebody what you're buying before they put the trade in, and that provides some leverage. Now, what I will say about this, I do not think this will have a systemic impact on the marketplace. So I kind of view it, I wish the people trading GameStop, to me, it's, very similar to a pump and dump thing, where if you're the first person in and the first person out, you can make a lot of money. But it's not a long-term strategy. And for young people who want to get involved in the markets, I recommend an S&P 500 index fund, and then to have diamond hands, which means have hard hands and don't sell. I do think you will have a regulatory response. Chairman Powell's been very cute in terms of his response to whether zero interest rate policy and all this free trading is fueling excessive speculation. There's questions about best execution. If you're selling your order flow, are you getting it? Are the markets being manipulated by Reddit? And to me, the biggest one is we want to make sure that our broker dealers and our financial institutions are properly capitalized. So to wrap all this up, we have massive liquidity, both coming from the Fed and out of Washington, that will keep the party going in the short run. The COVID profile is improving dramatically. Let's hope that continues. But I think that's the biggest risk we face. That V-shaped recovery looks like it is accelerating. So I ask here, is it sustainable? Barring a big resurgence in COVID or lots of problems with new variants, I think it is sustainable, and if anything, it is accelerating. Driving that is going to be very low interest rates, and we can debate whether rates are going up or down. I doubt they're going back to anything close to the historic numbers, so they will remain low for a long period of time. I'll take Chairman Powell at his word. Corporate earnings continue to exceed expectations, and I think there's a lot of leverage there. But we never live in a risk-free world. Virus resurgence. I think a big risk that is being underplayed in the marketplace is an unanticipated rise in inflation. I shared some of the things that are concerning in the marketplace, including speculation in the marketplace. But I do think as we roll into the second half of the year, you're going to hear more about rising debts and deficits. How do we pay for this? There almost certainly will be increases in taxes. What that ultimately looks like remains to be seen. The equity markets are on a roll, but I think the valuations should give people pause. And volatility, if GameStop and this volatility continues, it's something that, and then something that I think is flying under the radar is China tensions. So it's something that hasn't gone away and will likely remain going forward. So with that, I will stop and I'll turn it back over to Kerry, and if there's questions, I'd be happy to answer them.
Thank you so much, Ken. That was wonderful. I think you did a great job giving us an overview of kind of where we're at and things to look forward to. We do have just 1 or 2 questions if you've got a few minutes. So
please, I'd love to.
Great. So the first one said yesterday, President Biden signed an executive order to review supply chain fault lines in the United States. With a worldwide shortage of key components and commodities like semiconductors and steel, international automakers are reducing their projected volumes by 30 to 40%. In your opinion, do you believe that the projected GDP forecast is overstated?
Yeah, I don't think so. It could have some impact, but the auto sector, I think we have a somewhat of a nostalgic view of the automobile industry because it used to be 20% of GDP at its height. It's not quite as large as it is. I don't think there's any doubt that the shortage of semiconductors or the shortage of container ships too, which is really a big part of international trade and how we get this stuff over. So the executive order yesterday was basically an order to study how do we do this. And earlier in the year, the big problem was all of our protection garment, masks and gowns, and were all made overseas. And so that was kind of the catalyst of this. Now we have the semiconductors, which I think I read yesterday, something like 18% of semiconductors are actually manufactured here. They're developed here. The intellectual capital is developed here, but the manufacturing, the fabrication plants are not there. Unfortunately, you don't build a chip fabrication plant overnight. So I think this is more of a long-term endeavor, and I think it really speaks to the China tensions, the trade tension. So I think it's a great idea to look at that. Do I think it will shave points off of GDP? It may have an impact, but I think it will be marginal. So I think the rest of the momentum, and again, assuming we have a reopening, the fact that we can go out to dinner, go to the movies, go on vacation, take a cruise, fly in a plane, will dwarf whatever the supply constraints in the auto industry are.
Great. I know I'm looking forward to all that. You just
yes.
I hope to see the beach this year. That's my
yes.
goal. One more quick question. You did a great job giving an overview on the national impact, the global impact. What are some things locally that we should maybe be looking for, or maybe even that local impact specifically to Chenango County, especially when it comes to the investments that the government has been making over the last year?
Yeah. So I do think. New York State is a fascinating state. If you think about it, even from a geographic or a natural standpoint, very few states are as diverse as New York. If you think of Niagara Falls and you think of the Adirondacks and the Finger Lakes and being a Long Island boy, Long Island and the beaches there. I mean, it is tremendously diverse in terms of what it is, and economically, we're tremendously diverse as well. So as I kind of alluded to in my presentation, New York State, there's a big difference between downstate Manhattan and the surrounding suburbs, the metro area, if you would, and the rest of the state. Wall Street dominates the economy. Wall Street generates somewhere in excess of 20% of total tax revenue for New York State. So Manhattan looks terribly different than what Chenango County or Syracuse or Buffalo looks like. And I think the upstate economy is far more susceptible to higher tax rates, which New York is not a great place to do business. So from a policy standpoint, I would love to see us become a little bit more friendly. And I do think the $15 minimum wage. And I'm not, there are arguments on both sides of the political aisle when it comes to minimum wage. But I do think that would have a disproportionate impact on upstate New York. So I would look at corporate tax policy and the minimum wage as two of the most immediate potential changes in policy that could have an impact on upstate New York. That being said, I also think upstate New York, and I'm living it right now. I have, my wife is the youngest of 12, so I have 40 nieces and nephews. I have two nieces or two nephews who one was working in Boston, one was working in New York City. Both of them have been living up here in Auburn, my hometown, remotely for the last several months. And both of them recently got permission to stay up here. I am in the process of trying to get them mortgages. I got one, I think one's approved and the other is in the process. But I think upstate New York, if this, and again, I don't know what normal is, so we, and especially when it comes to remote work, I don't know what that looks like. And I think it's one of the great uncertainties. But what I would say, the quality of life in upstate New York is a heck of a lot better than being, maybe we're biased, but being a Long Islander and having lived in Manhattan earlier in my life, the quality of life up here is exceptional. The cost of living is so much lower. And I would point to the whole remote business trend. And again, the sustainability of that, who knows? But I do think there'll be a big percentage, whether it's 50%, 20%, 15%, I don't know. But even if it's, a kind of say a 15, 20%, that's material. And I think bringing that kind of workforce back into our environment is, I think, a huge positive for upstate New York and Chenango County in particular.
No, I agree, definitely. And that's, I think some of the initiatives that we outlined with the work of Commerce Chenango, I think that's, we're trying to capitalize on that. Because I think we're poised to be able to really, take advantage of what's happening in the United States. So wonderful. Well, I know, Ken, that you regularly share some of your market insights on a blog that's shared on the NBT website. So I know if we want to hear more from you and your perspective on what's going on, we can always check out your blog there. But thank you so much for your time and for doing such a wonderful job again this year.
Well, thank you. It's always an honor to be invited back, and I just regret that we were not at the country club or another facility, because now I have to go exercise, because normally I get my exercise pacing up and down the room. But that's one of the other adjustments we have to make. But I'm delighted to do it. I can't wait to be able to see everybody in person, and hopefully that time's not too far off. Thank you for having me.
Thank you so much, Ken. So we know the time, it's a little bit before 10, so we want to make sure we wrap things up. But just before we go, I want to just let you know about a couple of events that we have. So, Commerce Chenango is moving forward with some of our events for this year. We've been really conservative about doing this, and we've been strategic. So all of the events that we have planned have both a in-person, hybrid, or virtual dynamic to it, so that we can easily shift based on what's going on locally. So the numbers are trending the right way. There seems to be some movement with vaccines. I think comfort level is getting there. There is a new New York State standard that starting March 15th, you can start having large events and gatherings again in person with some restrictions, and we're going through those guidelines now. Actually, that information was just shared out yesterday, and we shared it on our Facebook page. And it will be in our newsletter. So if you have any questions about those expanded guidelines, please let us know or check out some of our social media. The next event that we have planned is a virtual webinar. It's an entrepreneurial roundtable series. We actually started this back in November. It's going to be March 30th at 12 o'clock. It's a lunchtime event. So this one's going to be directed toward MWBE. So, what the certification process looks like, addressing maybe some of the challenges that some of our local people have had. We're very fortunate to have Bud Sweet, the new vice president for region with ESD, is going to be on that call with us, along with a couple of other speakers. So we're very excited to bring that event to you. You can register for that on our website. May 12th, we are having a talent pipeline and population recovery strategy summit. This was one of the new events that I had planned to do last year. If you remember, I was very excited about our brand new idea. We had to put that on hold, but we are planning to do it this year. It's going to be on May 12th. It's going to be all day. There's going to be breakout sessions. It will be 100% virtual, so you can do it from the comfort of your home or your office or your home office, your car, whatever. But we'll be sending out some more information about that soon. Our annual event this year, we are planning to make this a hybrid event. The gala is our celebration of Commerce Chenango. It's what traditionally would have been considered our annual dinner, our annual event. We're planning to hold that at the Kansas Country Club. It will be in person, but there will also be a way to participate virtually if you're not comfortable coming. We will be making sure that we are complying with all of the standards set forth by the state with social distancing and masks. But we are looking forward to seeing some of our friends in person, hopefully on June 17th. And we are bringing back our golf tournament this year. So I'm not sure how to do this virtually. We haven't figured that out yet, but this is probably the one event that we won't have a virtual option. But July 23rd, our Chamber Golf Classic event will be held this year at Afton Golf Club. This was supposed to be held at Afton last year, and we ended up canceling it out of concern and keeping everybody safe. So those are some events we want you to just kind of jot down. You will be, all of our members will be getting something in the mail if they haven't already. It's our new membership book and a list of save the dates. It lists all of our events for 2021, and we're very excited to bring those back to you. Another fabulous, I can't believe how full this screen is. We started a new initiative this year. This was a brainchild of Mary Miner. It's called the Big 10 Club. So when our members are renewing, they have an optional 10% that they can add to their membership fee to support the work that we do here at Commerce Chenango. So like everybody else, we were very conservative when we built this year's budget. We didn't add a lot of extra frills, a lot of extra anything really. We're just trying to keep our eye on that bottom line and make sure we're making the most impact with our finances. The Big 10 Club is a way for our members to give a little bit extra and support us so that we can maybe think outside the box a little, maybe make some investments we didn't think we had the money for this year. I am thrilled about the number of businesses and organizations that have opted to be part of the Big 10 Club. This is the list so far. We're going to be recognizing the Big 10 Club in various ways throughout the year. I believe you have through March to pay your membership and do this Big 10 Club option if you haven't yet completed your membership for the year. But thank you from the bottom of my heart. This is going to give us the ability to do so many great things and add to the value of what we do here at Commerce Chenango. So I just want to thank all of our members of the Big 10, and we'll have more about that soon. And just one final thank you to our speakers. Thank you so much to MBT Bank for being our headlining sponsor for this event. Thank you to Preferred Mutual for being our supporting sponsor. Again, because of MBT and Preferred, you're able to attend this year's event free of charge, which is just wonderful. And shout out to the crew at MBT Bank that is doing behind the scenes today. We've worked really hard. They've done a great job of pulling this together in a flawless, seamless way. And so thank you to everybody who's been working hard behind the scenes, taking care of today's presentation. Thank you to John Watt for sharing some of his insights with us and for the continued support, and of course to Ken Entman for his perspective and insights. This has been a wonderful event, and thank you so much from all of us here at Commerce Chenango. Have a great day.